Farm finances are tumbling into a crisis that could reshape the future of agriculture. But here's where it gets controversial. While Wall Street watches the numbers, small family farms feel the squeeze on a personal level. And most people miss how deep this downturn really goes. Decreased crop prices and weak export demand are battering the agriculture sector, driving financial stress higher and dragging out a slump in equipment sales. According to Purdue University's latest Ag Economy Barometer, farmer confidence plunged 11 points in July to 135, following a 10-point drop in June. This index, based on feedback from about 400 farmers surveyed between July 7th and July 11th, gauges overall industry sentiment and conditions. Digging deeper, the Farm Financial Performance Index slid 14 points to 90, while the Index of Current Conditions declined by 17 points to 127. The Capital Investment Index, which tracks plans for machinery and other major purchases, dipped 7 points to 53, evidence of an ongoing slowdown in equipment orders and deliveries. Lower corn and soybean prices are a big reason for the slide. Corn fell 7% month over month, and soybeans dropped by 3%. At the same time, global trade tensions have muted export volumes. Michael Langemeier, Purdue's associate director at the Center for Commercial Agriculture, warns that China's usual commitments on soybean purchases have gone quiet, and that's alarming when you consider that roughly 40% of U.S. soybeans go overseas, with about half headed to China. Lenders are noticing too. Mark French, president of equipment financier Crest Capital in Atlanta, says softening commodity prices have made agricultural loans riskier. As farm revenues tighten, banks and captives are tightening credit lines, which in turn chokes off investment in new tractors and harvesters. Distress on the horizon, bankruptcy filings among small farms and commercial fishermen soared to nearly 200 in the first half of 2025, the highest tally since 2020. Meanwhile, farm debt is projected to hit a record $561.8 billion this year, according to USDA estimates. Larger operations can lean on land equity to muddle through, but many smaller and beginning farms lack that cushion. Langemeier predicts more bankruptcies as input costs remain high and break-even prices stay above current market levels. Smaller and startup farms without generational backing are especially vulnerable, he says. They simply don't have enough equity to ride out these low net returns. He expects 2025 to be tougher than 2024, with the downturn stretching into 2026 and more farmers struggling to repay loans. Glimmers of hope. Here's the part most people miss. Despite all the headwinds, 74% of surveyed farmers believe the U.S. agricultural sector is headed in the right direction. That optimism hinges largely on anticipated policy support. Many growers expect farm subsidies to increase, drawing parallels to the Trump administration's first term. Higher reference prices in the upcoming 2025 Farm Bill and additional safety net funding offer a financial cushion few think they can do without. Equipment makers are stepping in too. CNH Industrial and Agco are both working to clear out dealer inventories, easing pressure on farmers looking for better deals. CNH's CEO Garrett Marks said on the company's August 1st earnings call that they're rolling out customized financing plans for new and used machinery in direct partnership with dealers. So what's next? Will policy action and industry support be enough to steady the ship? Or is this just the beginning of a deeper shakeout? Do you think government intervention distorts market signals? Or is it the only lifeline farmers have? We want to hear your take. Agree or disagree? Drop a comment below.